Welcome to Theo Trade. This is Don Kaufman. It's June 20th, 2019, and you are watching the Theo Trade evening video. We're just moments after the cash close, with the S&P is closing effectively at an all-time high, 2960. But let's actually go kind of product by product, index by index, and dig into this rally just a bit here. What I want to get down to kind of begin this evening's video is the fact that the marketplace spiked higher prior to the cash open. People, we faded hard. I mean, really hard. Look at the size of this range. And you traded 29.65. All of a sudden, you're trading what? 29.35 at a low, and then ripped and bounced all the way back to effectively close right around that 29.60 level. But I got to tell you, it's not so much the S&Ps on my mind. I mean, like, what I like inside of the S&Ps, it's a pretty wicked range. I mean, who doesn't love, 30 points higher, 30 points lower, 30 points higher? We laugh, we cry. Let's actually dig, though, as I said, kind of sector by sector, indice by indice. So the S&Ps, enough said, right? They rallied, they faded, they rallied again. But when it comes down to it, the NASDAQ, well, the NASDAQ had rallied pre-market, and really it's hitting its high here right before the cash open. It faded and never fully came back. One of the interesting things is the fact that the S&Ps closed pretty much right at their highs. The NASDAQ, though, nowhere near its high. I mean, the NASDAQ was, again, it was 78.21. This thing closed at 77.64, so it's quite the fade inside of the NASDAQ. Now, that might be a tell. Again, that might be a tell moving forward into tomorrow's triple witching. It's a big expiration in tomorrow. But again, I got to go kind of product by product over here. Now we're actually going to skip down to it, get down to the Russell. The Russell didn't just fade after the cash open. The Russell was actually negative at one portion of the day. It bounced back up, but again, minimally so. So I was focusing on the Russell a portion of today's trading session, and I'm thinking to myself, I'm like, what gives? Well, the Russell is filled with kind of regional banks, kind of mid-level regional banks, and those banks are not doing well given the fact that, it's going to be what? Low interest rates for the rest of our lives, however long that may be. It doesn't matter because rates are going to be low now forever. It's infinitely low rates. Can you feel some of the sarcasm in there? Nevertheless, with the bonds, well, they're relatively flat today. Nevertheless, again, you have to look at this from an interest rate perspective. And those interest rates are not helping the banks anytime soon. So a lot of those regional banks, they don't perform very well in this kind of environment. So the Russell kind of lags behind. Now, moving on down the list. What a lot of people don't recognize, again, in today's trading session, I mean, come on, this entire week it's been all about the Fed. It's been all about the bonds. Except the bonds actually peaked out overnight. And again, I think it's of critical importance. As I said, the bonds kind of peaked out all the way at 156 and change, okay, in the overnight session, and they faded. This could be kind of a wicked reversal inside of the bonds. For those of you that will remember, earlier in the week, I actually took a bond position, a bearish bond position, specifically inside of the TLT. We'll keep eyes on that in the days to come. This could be it for the bonds. All right, kind of the last hurrah up. Again, 156, we're in just incredible territory. In fact, while I've got it on the screen, I got to pull up the TNX, because if you missed this, the TNX, which is the 10-year, it's the Treasury Index, I mean, its low today was in the 1.975. It's almost hard to say. It was below 2%, a 10-year below 2%. For those of you that have been tuned into Theo Trade for quite some time, I was talking about us hitting the 2% level. Wait for it, back here in March on a number of the weekend videos and the number of evening videos during the Theo Trade chat sessions. Said we're going back to 2%. We're there. Now that we're effectively there, I think in the shorter duration, I think you're going to see rates kind of bounce back up. So if you're trying to refi, you might want to think about it right now because, again, we're 2% on those rates. But in a larger sense, I want to show you one of the biggest impacts, okay, to me and to this entire marketplace. And that's this. So I'm kind of taking you like index product by index product over here. We talked a little bit about the bonds. But one of the most wild things is in the midst, okay, of a marketplace that's kind of breaking out, it feels, to the upside, you realize that volatility is up. Take a look. And, I'm not a big advocate, if you will, of the VIX. I think the VIX is my predecessor's volatility indication. But the VIX literally rebounded and ended the day almost 3% higher. Even the volatility futures, if it was just the VIX that ended higher, I'd say, no problem whatsoever. But it's not just the volatility index. It's also the volatility futures. The volatility futures, okay, pretty much from the get-go this morning, were on the rise. Again, volatility futures are up with the marketplace up. The VIX is up with the marketplace up. You look down to the bottom of the screen over here, and you'll actually see there's a 9-day volatility index. It's up almost 7%. Then there's a 3-month volatility index, okay? The only thing that was actually down was the volatility on the volatility index itself. Again, a wildly peculiar. Now, I don't want you to look and say, volatility's up at the market. That means we're going to tank. What it really means is that trade is absolutely taking, okay, a more protective stance. So we are, in fact, seeing an expansion of volatility as the market is going higher, okay? Could it be indicative, if you will, of the beginning of kind of a blow off top? Absolutely. But use what you're seeing in volatility being up with the marketplace up, less, okay, about bias to the markets and more, all right, about the relationship between the markets and hedging activity. Effectively, when you've got a marketplace that's up and the volatility contracts are up, okay, to me what it means, again, it is fever pitch. One of two things is going on, right, in this marketplace. When you see the VIX up with the marketplace up, in order to get volatility up, how do you do it? You have to buy options, and you got to buy options, okay, in kind of a fierce nature. So as I said, one of two things. What could it be? Predominantly, when the VIX is up, it's indicative, right? It's indicative of traders buying puts, specifically here in the SPX. Why the SPX? Well, because the VIX is a measurement, of course, of SPX options. In this case, sure, it could be the buying of a ton of puts, all right? And that would be hedging activity looking for a downside and the possibility of a downside move. But I think we have to take into account that this could be this wicked, blow off kind of a move to the upside, right? Take a look at the number of calls that traded versus the number of puts. The number of calls that traded in here leads me as a trader to believe that it was buying calls and buying calls in such a fierce manner that actually led to the VIX ending the day higher. So think about that for a second, because predominantly as traders, we're trained to think, hey, you know what? If the market, all right, volatility is up, it's got to be puts. They're buying puts because, right, supply and demand, everybody demands puts. Nobody has demand for calls. It's not true. Today, they actually demand calls. Now, when I was talking just a moment ago, I said, hey, look over here. I go, look at the number of calls that are traded versus number of puts. On a prototypical day, you get, all right, almost twice the number of puts trading as calls. In fact, the Sizzle Index over here speaks volume. Sizzle Index is today's option volume versus the previous 5 days option volume. Okay, and if you look at the Sizzle, the number of calls trading here, again, in the SPX, that's extensive. You're like, oh, whatever, it's only 2.3 times the norm. No, this is the SPX. This is the mother of all products. And the mother of all products trades 2 times the norm. It is a ridiculous amount of options that have traded. In fact, 2.1 million contracts traded. 2.1 million contracts traded just, okay, in the SPX. Now, I want you to think about this for a second. Do some quick and dirty math. So you got 2 million contracts in the SPX. Why not? Let's look at the spiders. The spiders did almost 5 million, okay? Almost 5 million contracts in here. Wait for it. Go look at the VIX. The VIX did another 500,000, okay? You know how many contracts we traded net yesterday? The entire marketplace yesterday, okay, did 19 million option contracts. That's the entire marketplace. Do you realize, okay, the SPY, the SPX, the VIX. First of all, they're all interrelated. The Spider was good for almost 5 million. The SPX was good for 2. This is good for 0.5. Before you know it, what are you at? By the way, there's a handful of other products over here that also mirror the S&Ps. Before you know it, you what? 7, 8 million contracts. And the SPX is like 20 or 30 times the size of the other contracts. It's almost a $3,000 product. The SPX options, tell a vastly different story. Because if you come in here and think volatility is up, that means the market's going to tank. I'll actually give you the contrary. The volatility is up because there's such fierce buying of calls inside of the SPX. And the reason I'm spending so much time on this, that absolutely could be indicative of that kind of blow off top. And that's what everybody wants. Everybody wants to know, like, well, how can I use this for directional bias? I'll tell you what, when the trading community starts buying calls in such a fierce manner, if you want to use it as a contrarian indication, go for it. Because this is a very rare occurrence. Now, to continue on, as I said, I was going to talk about individual products, a couple of different sectors over here. There's another aspect that you have to look at today underneath what I would term the belly of the beast. And you know what's going on in the belly of the beast? Right here, the financials. The financials fairly lackluster today. They were up 0.44% with almost a 1% rally. There's one thing that you almost never see. Again, there's a couple things on the screen that are rare, but there's one thing that you just handful of trading sessions in a decade, right, that you'll see this. It's rare to see the S&P is up almost 1% with the financials not involved. How is this even possible? How is it plausible? The financials are massive. There's only one answer, and it isn't the monsters of tech. It has everything to do today with energy. Energy literally saved the day. Energy, it's not exactly the most massive of what? Of your products out there, of your sectors, but being up 2.2% is rather massive. So you had oil obviously spike higher. Everything that's going on inside of the Middle East. Your energy stocks follow. They're up 2.2%. And what that in effect did is it covered what was going on inside of the financials. What is going on inside of the financials? Well, broader weakness right now. This is something to be considered in the days to come. It's critically important. Again, the financials are in a stall, right? Pretty much since the FOMC came out. In fact, they reversed and they're kind of flat since the FOMC information out there, which is what? Again, interest rates low forever. Now, last but definitely not least on kind of this, nightly report, I want to talk about the SPX. This one also fairly monumental. The SPX itself is well outside the expected move. Now, for those of you, if you don't tune into the expected move, you can go, if you're on Thinkorswim, you go into the Analyze tab on Thinkorswim. And I'm actually going to pull this down for a second. Pull it down. Cruise over here. So what are we at today? The 20th. Just drop back to the 16th. Why do I go back to the 16th? Because I want to see what the expected move was. And I know what the expected move is. I have it drawn on my screen. Nevertheless, I want to show you the expected move is about $41. And I said this, on this weekend's video, this previous weekend's video, and I said the expected move, $41. Looks absolutely ridiculous. Why? Because we blew through expected move here. We blew through expected move here. We did it again here. They give you a $41 expected move. That's $41 higher, right? Or $41 lower. And they give you this expected move. And then all of a sudden, look at this. All right. The SPX moved $27 today. So we are definitively outside, which is going to make this expiration, and again, it's a monthly expiration. This is big, people. This is really big. We are outside the expected move by a substantial amount. Now, for those of you that do follow a little bit about TheoTrade, we happen to have a butterfly centered right there. 29.30 is the center strike for our butterfly. So I'm unquestionably asking for a little bit of sell-side activity tomorrow. The big question is, are we going to close once again outside the expected move? On a monthly basis, again, this is absolutely huge. The marketplace has done a horrific job of being able to handicap risk. I mean, come on, we're moving up with volatility going up. We're blowing through the expected move. Everything in the marketplace right now just screams of inefficiency. There's a lot to think about, of course, in today's marketplace, and a lot more that's going to be going on tomorrow. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.